What's up, everybody? It's Michael from the Investments Lawyers, and today we are going to go through a rather long video about how investment funds work. Okay, so let's dive right in. So why would anybody even start an investment fund? So here on this chart, we have principals, managers. These are people who make investments. So a lot of people start out, they're like, hey, I like investing in real estate. Maybe they have some houses, some duplexes. Maybe they like investing in businesses like SMBs. Maybe they like investing in public stocks. Maybe they like angel investing. There's all sorts of investing out there. And these people might have had some success. Like, hey, I'm pretty good at investing. Maybe their friends and family want to invest money with them. That's very common. People will be knocking the door down. They're like, hey, I want to give you my money. Can you invest my money for me? So that's a pretty common way for how these investment managers, called principals, get started. So if somebody wants to start an investment fund, what's the first step? What do they have to do? So let's go to the next slide here. Okay, so let's say somebody wants to start an investment fund. What's the next step? Okay, so what we have here is a very simple beginning of a structure. So at the bottom, we have the fund. And the fund is typically a limited partnership or an LLC. Then we have the general partner, which is the entity that controls the fund. So as you'll see, the principals, the managers, the people running the show, they control the general partner, and the general partner controls the fund. Now, the other important party here are the limited partners. These are passive investors. These are people who say, hey, managers, I want to give you $100,000, $200,000 to invest on my behalf. So those are the two main parties in a fund. There's the general partner who runs the show. They invest some capital too, but not as much as the limited partners. And then there's the limited partners who put most of the capital in. And how much money the general partner puts in really depends on the industry and the fund size. It could be anywhere from like 1 to 10%. So how does an investment fund work? When limited partners sign up to join a fund, they don't wire all the money at once. So if a limited partner has a commitment of $100,000, they don't just send $100,000 immediately once they sign up. Instead, the fund calls capital over time. So if the fund has an investment it wants to make, let's say an investment in an apartment building, they might call, let's say 10% of the capital from the limited partners, and the limited partners will contribute that, their capital contribution. So let's say, the investor has, let's say the fund size is $10 million. This investor has a commitment of $100,000. And let's say the fund needs $1 million, so 10%. Of the fund size to make this investment. They'll call 10% of the capital from the limited partners, so a total of $1 million. For this investor that we're talking about, their commitment is $100,000, so they'll send in $10,000. And then the fund will make that investment. And, that will happen over and over and over. And we'll show how that happens in a later slide. So how do investment managers get paid? One way that an investment manager gets paid is called the management fee. And this is a recurring fee. It's kind of like a salary. A typical management fee might be 2% of committed capital, maybe 1.5% of committed capital. In many cases, the fee steps down to X percent, 1%, 2% of invested capital over time. I have other videos where we explain how exactly management fees work and get into the nitty gritty, so you can look for those. But this is one main way that the investment managers get paid. It's a recurring management fee, and that will typically be paid quarterly. Now, the management fee is mostly used to pay the salaries of people at the general partner, or office space, laptops, stuff of that nature, that would get paid by the management fee. Now, you just heard me accidentally almost say management company, and why that is because in most funds we actually have another entity called the management company, also owned by the principals, and that's actually the entity that usually gets the management fees. This is a very simple structure we have up here just to make things easy to understand as possible. But if you're like, hey, where's the management company? I know, in most funds we have a management company. So over the fund's life, the limited partners will keep sending more money to the fund, and the fund will keep making investments. Now, eventually, these investments might start making money. Let's hope so. So let's go back to the apartment building example. the apartment might generate rents, and those rents will be distributed to the limited partners. So typically how it works, and this is different in many funds, so it's not in every fund, but typically the LPs, the limited partners, will get all of their money back before the general partner starts making what's called carried interest. And carried interest is the second way that investment managers get paid. The carried interest is a share of the profits. So it's the share of the profits. So profits typically mean that the investors have gotten a return of their capital. So if they put in $100,000, they got $100,000 back. And then after that, the general partner might get a share of the profits. A typical percentage for carried interest is 20%. So after the LPs get their money back, the GP gets 20% of the profits, and the LPs get 80% of the profits. That's very common. This decision of how profits are distributed is called the waterfall. You might hear, oh, what's the carried interest waterfall? That's what this is talking about. And this can get very complicated. There can be preferred returns, GP catch-ups, different tiers. People get very creative with this. A very standard way is in venture capital to have a return of capital, then an 80-20 split. In private equity, real estate, it's common to have something like, let's say, return of capital, then a preferred return, let's say, of maybe 8%, and then 80-20. But again, this is highly variable. Different funds have different waterfalls. So just to recap, the two ways that the managers get paid are management fees, which are kind of recurring income like a salary. And then after the LPs got their money back, the GP will get a share of the profits. So over time, the fund is going to sell these investments. A typical fund might last, let's say, 10 years. So at the end, or when it's just opportunistic to do so, the fund will sell investments, and money will be distributed to the LPs, typically, let's say, 80%, and 20% to the GP after the LPs have received a return of capital. And then eventually, everything's gone. All the assets have been distributed. Hopefully both parties are happy. And if things went well, then typically they would start over. And now, we have a fund two, a new general partner, and they just do it all over again. Many successful investment firms will have, several funds in a row. It's pretty typical. So thank you for sticking around for this video about how investment funds work. I hope it was helpful to you. If you have any questions, you can always reach out to me. I'm at investmentslawyers.com, where we form investment funds and SPVs all day. But again, thank you for sticking with me, and we'll see you at the next one.